How to become your own banker. You just have to copy what they do. My name is Daniel. Last year we got 1.3 million out of banks. Here's why. First, we have to understand how banks work. Excuse the terrible drawing, but me and you give our money to banks. Banks are not coming into the industry with billions of dollars. They get our capital from us. From there, banks, just like a human being, have an asset and liability list. They are putting their money somewhere. So if you give money to a bank, they're not just keeping it in a safe. They are putting most of the money in loans. We might not have access to these. We do have access to the rest. The next, government bonds, bills, notes, etc., real estate. But the problem is we wouldn't put our money there as an alternative to the banks because it's not going to be as liquid in those two spots. Now, banks need a place to put their money that they're going to use for expenses as well. Think about why any of you have a bank. That's because we have transactions, expenses we need to pay for. We can't just lock all of our money up in investments that we can't access. For banks, it's the same thing. Where they're going to earn 5 or 6% net from this, then they're going to credit us, me and you, usually somewhere less than 1%, that's the average in America. That interest is going to get put right into our account and go right back into the bank, and the cycle's going to repeat. Now, banks could, if they wanted to, put their money in other banks for their expenses, but they don't do this. Why is that? That is because there's an asset that is better. There's a little over $205 billion across big banks in this asset. Currently, Bank of America has over $24 billion in this asset as of 2024, $19 billion for Wells Fargo. And before we even continue, if the big banks are doing this with their liquid cash, the very institutions that come into business with no money and make all of their profits by making financially sound moves, they're frankly known for screwing people over with high interest loans. Don't we think that what they're going to be doing with their liquid cash is going to be financially sound? It would seem to answer otherwise would be absurdity, and that is that they are putting their money in insurance companies. They use what is called, and there is a version of this for everyday people, called bank-owned life insurance. The reason that they do this is four things. First, this money is going to be much safer in an insurance company than it is in a bank. Now, legally, insurance companies aren't even allowed to be as risky as banks when it comes to their portfolios. Their loan-to-value ratios are much closer to 50% as opposed to banks that get much closer to 80%, obviously much higher risk. We know that as well just looking at the Great Depression, looking at 2008, 9,000 banks went under in the former, over 400 in the latter, making them clearly the safer institution. That's why the big insurance companies weather the financial recessions without breaking a sweat. Second is going to be that this money that grows inside of a life insurance policy is going to be able to be accessed tax-free. So in a bank, even if you are getting credited interest, you still have to pay taxes on that money. In this case, you will not have to pay taxes. The money you receive is going to continue to compound year over year. This makes a massive difference in the long haul as well. Third is going to be simply the rate of return. If you're getting an average of less than 1% in a bank, even if you have a high yield savings and you're getting currently around 3.8, you're still going to get a much higher rate of return in an insurance company. Why? Because even if it's the same, it's actually tax-free. And lastly is the liquidity. Like we said, they have to have a bank of sorts for themselves as well, where they can access their money and pay their overhead. This is why this can function as a bank. So instead of using bank-owned life insurance, or corporations also use this called corporate-owned life insurance, you can just use regular old cash value life insurance. And the owner's not the bank, but it's simply you. You've cut out the middleman. Again, a beautiful drawing here by myself. You put your money in the cash value life insurance. Cash value life insurance then credits you the interest that's going to continue to compound. The banks are off to the side now. They were not taking your money to go and put it somewhere that you could have just done yourself and then crediting you way less. You can see here, now the banks are sad. And for people who so passionately disagree with this method of becoming your own banker, you have to ask. No one is going to ever go out there and say, Walt Disney and Dave Ramsey, they don't know the first thing about business. Well, they have very different theories in terms of how to operate with money. Now, they both have built very successful and large businesses. Obviously, Walt Disney is much larger, so maybe an unfair comparison. And Walt Disney also was the one who used cash value life insurance to fund his entire legacy. However, you wouldn't say that these people don't know the first thing about business. That's how they made their livelihood from the ground up. Clearly, they have a track record and an overwhelming amount of proof to say that they do know the first thing about business. Now, it'd be absurd to say that banks don't know the first thing about financials. Now, you can disagree with the morality of how banks operate with loans, for example. I would agree with you, but if we're specifically talking about a utilitarian approach to what is going to yield a higher return and what's going to be more financially beneficial in the long run, well, this seems to be a no-brainer. Now, moving forward, to do that, when you want to get a cash value life insurance policy, you cannot just get any permanent life policy. They have to be structured in a certain manner. The first thing is that this is what all the banks are doing. This is also what all the big entrepreneurs are doing, like Walt Disney, like Ray Kroc, the founder of McDonald's, J.C. Penney, Tony Robbins, I could go on. But they are making sure that when they put money into a policy, that the highest portion of that money that is allowed by the IRS is going towards the cash value, and the least, as defined in the Internal Revenue Code, is going towards the death benefit. When this is the case, they are complying with the tax codes that say, well, you have to have at least this much insurance for it to still be considered life insurance. Otherwise, it's not going to be considered life insurance and you're not going to get these tax benefits if you don't have at least this much insurance. And since that's the case, since you do have that in place, you are going to be able to grow this money tax deferred. You're going to be able to access it tax-free. And when you die, it's going to blossom into the death benefit and transfer tax-free. And that tax deferral status and the growth, you never even had to realize it, making it all tax-free. When you get to the point where you want to borrow from a policy like this, there's plenty of different ways you can do this. If you want to take tax-free income from these policies, you can do that completely tax-free. The withdrawal rate also that you're going to be able to take is naturally going to be much higher than it would be with a 401k or an IRA. Why? Because you don't have to worry about market downturns. It's also tax-free, so it's naturally going to be higher. Lump sums is the next thing. If you want to take out half of this money and give a donation to a church, buy a fancy house, it does not matter. You can do that. And if you would like to, you can pay those loans back and let the money continue to grow tax-free. That is completely optional though. If you don't pay it back, the death benefit is always going to be a little bit ahead of the loan balance. And when you pass away, that death benefit will pay it off, and then the remainder will transfer to your heirs' income tax-free. Real quick, let's look at a quick example of what this would look like. I have here a 25-year-old starting, putting in $50,000 a year. You could do this at age 60. You could do this for $5,000 a year. It doesn't matter. You can adjust the numbers. But you can see here, putting in this much a year, and then he's able to loan money out. So let's say in year 3, he took a $100,000 loan. You can see his loan balance is continuing to grow. However, his surrender value is also continuing to grow, actually a little bit ahead of that loan balance. So when you're paying interest for the loan, the insurance company is actually going to credit to you an equal or even more interest than that. There's a couple different ways to do that, but that's for another video. And say that, hey, it wasn't even until 10 years later and he was finally able to pay back only half of that loan, $50,000. That's fine. In fact, he still has a surrender value at this point of $700,000. So if he wanted to take out a big $350,000 loan and never pay it back, well, that's weird. His money is continuing to grow even though he has this $1.6 million loan balance at age 57. That's alarming, right? Well, no, it's not, because he has an account value of $4.3 million, and all that happens, because that's continuing to grow even while he's took the loan out, all that's happening is you subtract the loan balance from that account value, and that's how much money he has access to. So he could still take out $2.7 million completely tax-free and not worry about the loan. So somehow, let's say he takes out $2 million this year. Well, the loan balance is now $3.7 million. So maybe seems like that's getting pretty scary, but actually you still have an accumulation value of $4.3 million. So he still has another $629,000 that he could have access to tax-free. When he passes away, you can see the death benefit on the right is a little bit ahead of that. That's because all that would have happened is the total death benefit would have been a little bit ahead of this account value here. It would have paid off this $3.7 million loan, and the remainder, $661,000, would have transferred income tax-free. So if you don't understand all the numbers, you don't have to. Think of it just like a bank. You're putting money in. You can borrow from your own bank. Use that completely tax-free. You don't have to pay the loans back. The death benefit will. All of it stays completely tax-free. If you'd like to learn about this in much greater detail, click here to learn about Index Universal Life in the greatest detail on the internet. I will see you there.